Hi guys and welcome back. My name is Saurabh Mutha and I am teaching you a very interesting topic on tax today. Lots of people struggle with this but not you after this video. It's a topic on salaries and it is called retirement benefits. Guys, everyone loves weekends. I personally love the weekends. I also equally love the Monday morning. But lots of people don't love this retirement benefit part because they feel it's too difficult. So let me explain what I'm talking about. Guys, in the chapter called salary, I have a story. If you know me and if you've attended my lectures, you know the story. But if you don't have not attended my lectures, also you'll find it convenient. So there is this guy who's a surgeon, and his son gets a job in a private firm, but he is not very fond of that. He wants his son to get a government job because surgeon loves government positions. Now, why does he love government jobs or government positions? We will see soon. And this entire half hour, 45-minute video covers everything that is to do in retirement benefits. Don't spend any more time. Just watch this video and you'll get a very good grip on retirement benefits. First, before we go and start retirement benefits, which part of this is a chapter called salaries. And in salaries, there are different retirement benefits. We're going to talk about all of them in this video. Is this really important? Not honestly, and that's the reason this video is very short and crisp, so that you can watch this video and revise even one day before the exam. You don't need to get into the nitty-gritties while reading yourself, because this is not the most important, does not come in the exam very often. Watch this video, do one sum on each concept, and then you are good to go, and do not do anything more on retirement benefits. Now, what exactly are retirement benefits? Guys, when you do a job, you get salary. Every month you get that. Plus, let's say you get dearness allowance. You also, let's say, get commission. You get other benefits. But this retirement benefit is typically when you retire, what do you get is retirement benefit. Before we move ahead on retirement benefit, I would like to give some short forms for people who are new to this. Guys, basic salary, we are going to be calling as B. So basic salary, we are going to be calling as B in this video ahead. Any dearness allowance which forms part of retirement benefits, that dearness allowance which forms part of retirement benefits, we are going to call it D. And that dearness allowance which does not form part of retirement benefits, we'll call it OD. Just some short forms. Also commission, which is given as a percentage. Example, your commission in your job is 1% of the sales you make. If it's given as a percentage, we will be calling it C. And the commission which is fixed, example, every year you get 1 lakh rupees commission, that will be called OC. Guys, these are just short forms for you and me to understand. They are not required from any other perspective, just from an exam understanding perspective we need. So this is B, focus on B. This is D, this is OD, and this is C. These are some short forms. If you already been my student, you know these short forms already. Now let's move ahead. What are these different retirement benefits? So I'm taking a fresh page and I'm telling you the different retirement benefits through a shortcut, which is like this. Guys, in a job, once you finish your job, gradually people leave, they retire. So either some people leave, वो छोड़ देते हैं office, या they retire, or they voluntarily retire post service. What is this, guys? This is a shortcut, so you remember all the retirement benefits at one go. And also, guys, at the end of the video, I will tell you a very nice technique of remembering the sections also. So watch the video till the end. So gradually people leave, retire, voluntarily retire, post service. These are all the different retirement benefits. Let's start with the first one. We'll start with the first one here, which is basically retirement gratuity. Let's talk about this and let's talk about what does gratuity mean. So the first one which we're going to talk about is gratuity. Guys, if you want a best way to watch this video is also in 1.5, so you can watch this video even faster. Gratuity is basically something that the employer gives you. I call the employer master. And the employer gives you because you worked in an organization for a really good number of years. They give you gratuity. It's like a thank you, and it is generally given at the end of your term, or when you retire, they give you gratuity. So gratuity is basically a thank you for working in an organization, and it is a lump sum amount given at the end of the term. Now, let's say in your organization, your boss gives you a lump sum 22 lakh rupees as your retirement benefit. So will it be taxable? Yes. Which room will you open? You will open the room salaries. Yes. And in salaries, you will add 22 lakh rupees. So is it taxable? Yes, it is taxable. But having said that, they give you an exemption they give you an exemption which is least of the following always, guys. So there's an exemption which is least of the following. What are the least of the amounts? Let's see. The first one is the amount that you've received. So the amount that you've received is example 22 lakhs. So that could be one of them. Second one is a statutory limit. That means a fixed limit. This limit is fixed by the government. Right now it is 20 lakhs. It's a big limit because this is a big thank you. So remember, it is either 22 lakhs, which is the example, it's not fixed, the statutory limit of 20 lakhs, or third, it is basically a formula which I'm giving on the screen. It is half month's salary. So 15 by 26 is half month. Yes, I know there are 30 or 31 days in a month, but the calculation given by the Income Tax Act is 15 by 26 into BDOD. Now, what is this BDOD? I told you, B is basic, D is dearness allowance, which forms part of retirement benefits, and OD is that dearness allowance which does not form part of retirement benefits, into completed number of years but rounded off. What do I mean by completed number of years? Let's say you're retiring after 20 years and 9 months, then 20 years and 9 months become 21. Anything that is more than 6 months becomes the next number. So 20 years and 4 months will become 20 years. So it'll go back and it'll go ahead. You have to basically round off. Example, 20 years and 10 months become 21 years. And whichever is the least, so let's say this is 15 by 26 into BDOD. Which month's BDOD? Last month's BDOD. So if you're retiring today, that is in the month of January, then December's BDOD into completed number of years rounded off. This you will do. And whichever, guys, whichever is the least, so let's say this is 5 lakh rupees. So you will get an exemption of 5 lakhs. So whichever is the least is the exemption that you will get. So this calculation is absolutely important. This is least of the following. Now, having said that, I told you surgeon loves government jobs. He loves government jobs because, guys, in government jobs, there is an added advantage. I'm writing it here that this amount, this gratuity, if received by government employees or government slaves, is completely exempt. Just 1 second. So guys, if this same gratuity amount was received by a government employee, example, if you were working for the Indian Railways, then this was completely exempt. That means did you have to do this least of the following, etc.? No. And that's the reason, guys, I had given a shortcut called surgeon loves government positions. If you remember that, surgeon loves government positions. So for government jobs, gratuity, G for gratuity, that is completely exempt. Now, guys, there is an act called POGA. I'm just going to color it differently and tell you guys there is an act called POGA. Now, what does this POGA mean? POGA is Payment of Gratuity Act. That means they've made it compulsory. Otherwise, Indian employers will not pay you gratuity. So they've made it compulsory under an act called POGA. You don't have to remember all this. Don't worry, guys. You just have to remember this formula. But there's an act called POGA. If you're covered under POGA, then this is least of the following. But if you're not covered by POGA, then only a small change happens. Let me tell you, if you're not covered by POGA, then what happens? Here we go. Just want to show you, if you're not covered by POGA, then what happens? Then it is again least of the following. First is the same amount received. So no change there. Second is also the same statutory limit of 20 lakhs. So no change there. But only the third thing has some changes. Let's see. This was 15 by 26. This 15 by 26 first change, it changed to 15 by 30. So 26 became 30. That is the first change. Next, this was BDOD. It became BDC. But last 10 months average BDC. So you have to take the 10 months average BDC. Example, if you're retiring today in the month of January, then December, November, October, you have to go last 10 months, calculate for each month BDC and divide by 10. And into completed number of years, but this is not rounded off. So there's a small change here if you're not covered by POGA. So just repeating, 15 by 26 becomes 15 by 30. BDOD becomes BDC, but average BDC, that means into 10. And completed number of years, this is not rounded off. So let's quickly recap what is gratuity. Gratuity is a big thank you. The organization says thank you for working for so many years. Here is a gratuity. So they give you an amount. That amount, is it taxable? Yes, you will add it first, but you will minus the amount that is least of the following. What is the first amount? Amount received. Second amount, that is a statutory limit of 20 lakhs. And third is 15 by 26 into BDOD last month's into completed number of years rounded off. That's if you're covered by POGA. If you're not covered by POGA, 15 by 26 become by 15 by 30 into the last 10 months average BDC into completed number of years not rounded off. And congratulations, if you're a government employee, then this will not impact you because it's completely exempt. Guys, this was the first one, that is gratuity. Let's move to the second one, which is P, which is pension. Very, very simple. Let's understand what is pension. So here is the second one, guys. We are talking about something called pension. Guys, the best part about jobs, many jobs, is that even once you retire, you get monthly pension. So pension can be received monthly. So the first way how pension can be received is called monthly pension. And this is taxable for everyone. You open the door of salaries, you tax monthly pension there. Example, if a monthly pension is 40,000 a month, so 40,000 into 12 is 4,80,000, and you will also get the standard deduction of 50,000 rupees, which everyone gets in the salary set. This monthly pension we are not talking about because it's taxable, there is no exemption. But let's say you don't want month by month pension, or you want some amount of that monthly pension to be given you lump sum. So there's another way of taking pension, which is called lump sum pension. So let's say you say, I don't want 40,000 pension. Can you give me only 10,000 per month? And that 30,000, can you commute it? That means, can you make it lump sum and pay me? So they say, okay, so this is called lump sum pension, and we'll see how lump sum pension is taxed. Example, you get 30 lakh rupees as lump sum pension. So you will first tax it. Yes, you will add it. And this lump sum pension, you get an exemption, which is least of the following. Yes, you heard it right. Again, least of the following. First, let's see how this pension, sorry, this is not least of the following. Sorry, my bad. It's just a simple number. It is basically given as half of your total pension. So if 30% is 30 lakh, they will calculate the total pension. Example, let's say that your pension, total pension was 40 lakh rupees. Out of 40 lakh rupees, you will receive 10,000 every month, and the remaining you've computed as 30 lakh as the lump sum pension. Then from this 40 lakh is the total pension. I repeat, there is a total pension of 40 lakh rupees. Out of that, some you've taken monthly and some you've taken lump sum. The monthly pension will be taxable. Lump sum also will be taxable, but you'll get an exemption, which is half of your total pension, not half of the lump sum, but half of the total pension. Example, let's say your total pension is 40 lakh. So half of that, that is 20 lakh, will be exempt. So only the balance will be taxable. I hope this is understood. Quickly recapping. Pension, if it's monthly, it's always taxable. Lump sum pension, you will tax it, but you will get an exemption, which is half of the total pension. But there are some conditions apply. There are some exceptions, which I will talk about here. The first exception I'll call A. If you're already getting gratuity, that means you had learned gratuity just before pension. If you're already getting gratuity, then they say that we will not be able to give you half such a big exemption. So in case you're already getting gratuity, then this half number will be reduced and it will be made 1/3 of the total pension. That's the first exception. So example, in the exam, they say you're already getting gratuity. If you're already getting gratuity, then it's 1/3 of the total pension. Because you're already so rich, they don't want to give you such a high exemption. But if you're not getting gratuity, then 1/2 of the total pension. Second, if this pension is received from an LIC policy, then it is completely exempt. And third, if the lump sum pension is received by the government employee, then also it is completely exempt. As you know, surgeon loves government position. That's the next one. So this is position, this is pension. But remember, guys, monthly pension is taxable for everyone. This we are talking about the lump sum pension. Let's quickly recap this, everyone. In the exam, if they say monthly pension, which they can ask, monthly pension, you take it to salaries, tax it for everyone. Government doesn't matter. But if you get lump sum pension, that is commuted pension. The word is called commuted pension here. And this is non-commuted pension. Commuted, the spelling is COMMUTED, commuted. Commuted means lump sum. If you get lump sum pension, you first tax it, and exemption will be half of the total pension. If you're already getting gratuity, it will be 1/3. For LIC, it will not be nothing, and government employees, it will be nothing. Guys, this is the second one, that is pension. Now we move to the third one, which is leave. All right, the next up is another retirement benefit, which basically here it is. It's called leave salary. I'll tell you about my boss at work, my manager. He used to always be in office, used to never take leaves, and I used to wonder why he's not taking leaves. He's always around in office. And the reason he was always around is because he would encash his leave. So that is called leave salary. It is also called leave encashment. Whichever leaves you don't take, you can encash them and you get money in respect of those leaves. So again, those are two types. One is which you get during employment. So while you're working, if you need extra money, you're getting married, you need a new phone, a laptop, a car, and you encash it, it is fully taxable. For everyone, yes, for everyone, it is fully taxable. The second one is on retirement. If you get it on retirement, then it'll be taxable with an exemption, which is least of the following. You will be taxable, but you will get an exemption, which is least of the following. So let's take an example here. Let's say you got 10 lakh rupees or 10 lakh 50,000 as your leave salary. So will it be added? Yes, but you will minus the least of the following. Now, what is the least of the following? Let's see. Always the first is the amount that you receive, 10 lakh 50. Example, 10 lakh 50. Second is a statutory limit. In this case, it is 3 lakhs. So I'll tell you how to remember it. Keep the number 3 for leaves. Keep remembering the number of leaves as 3. So statutory limit is 3 lakhs. In gratuity is a big number, that is 20 lakhs. Here it is only 3 lakhs. Third, you calculate the last 10 months average BDC. 10 months average BDC. B is basic. D is that retirement, which is that DA, which is forming part of retirement benefit. And this is C, which is a percentage of turnover. You take the last 10 months average BDC and you multiply it by 10. That is one. And the last one is you multiply it by the leaves pending, by the pending leaves. I repeat, first two are very simple. Amount that is received, that is 10.5 lakhs. Statutory limit always is 3 lakh. And 10 months average BDC you have to take. Basically goes to the last 10 months, take the BDC, do the average, and into 10 you multiply, and into pending leaves you multiply. Now, what is pending leaves? Let me just talk about that. Just 1 second. So these pending leaves basically are as follows. I'll just explain. Pending leaves, let's say you worked in an organization for 20 years and 6 months. So that is 20 years. And every year you got 40 days as leaves. So 40 is basically 800 leaves. But they say that you cannot take 40. Even if you get 40, for this calculation, you can maximum take 30 leaves, which is basically 600 leaves. These are your total leaves over 20 years. You don't have to round off. You have to only say completed number of years. Now, after this, from this 600 leaves, you must have used some leaves. That means either taken those leaves or encashed those leaves. So let's say those leaves are 150. So remaining is 450. But these are number of days. So you have to do in number of months. So this divided by 30 will give you 15. So basically this is 15. This is how you get the number 15. This is an example. It could be different for different people, but I'm just repeating. As leave salary, if received during employment, it is fully taxable. But if received at the end, then it is taxable with an exemption, which is least for the following. First, amount received. Second, 3 lakh. Third, 10 months average into 10. Fourth, 10 months average into leaves pending. What is pending leaves? The number of years you complete into the number of leaves every year, but that cannot be max more than 30. Minus the amount of leaves that is used and the balance that is divided by 30. So pending leaves in terms of number of months. And good part, good news, guys. If you're a government employee, then anytime you receive it, not during employment, but of course on retirement, when you receive it, it is fully exempt. And that's the reason, guys, surgeon loves government positions. If you remember, surgeon loves government position. The loves, the L was basically leave salary. So for them, whether they get gratuity, whether they get lump sum pension, or whether they get leave salary on retirement, all of these are fully exempt. All right, getting now to the fourth point. The fourth point is here, guys, which is very simple. It is retrenchment compensation. I'll tell you all about it. But first, the letter is R. So gratuity, pension, leave salary, and now retrenchment compensation. Let's talk a little about that. This R, that is retrenchment compensation, is a very simple concept. Let me talk about it. So this is the word. It's called retrenchment compensation. Sounds complicated, but it's very simple. I'll tell you what. Guys, lots of time you feel that people are laid off or they are fired from their office, recession, etc. We are not talking about blue collar employee who have very fancy jobs. We are talking about workers, etc. From a factory, workers are removed. It feels very bad, and hence the government has made it compulsory that they should get some retrenchment compensation. Of course, even that is taxable. Yes, you heard it right. That is taxable. But don't worry, you will get an exemption, which is least of the following. So the exemption is least of the following. This is very similar to gratuity, POGA gratuity that you saw. First amount is the amount that is received. So let's say you received 6 lakh rupees. So that will be here. That is just an example. Second one is basically a statutory limit, which is 5 lakh rupees in this case. And third, it is 15 by 26. It is BDOD. It is completed number of years rounded off. So it's exactly similar to gratuity POGA, except that it is 3 months average BDOD. So this is the only change. Yes, this is the only change that you're looking at. So retrenchment compensation, if it comes in the exam, what do? You first add it, and then you minus an exemption, which is least of the following. A is amount received, as always. B is 5 lakh. In this case, it is 5 lakh. In leave salary, it was 3 lakh. And in gratuity, it was 20 lakhs. And the last third one is similar to gratuity, which is 15 by 26 into BDOD into completed number of years rounded off. But only thing, it is 3 months average. So this is retrenchment compensation, and there is no government exemption for that. So surgeon loves government positions. This is not in that shortcut. Guys, this is the fourth retirement benefit which we've just covered. Let's move on to the last three. Voluntary retirement, post service. These are the last three that we're looking at. The next one is voluntary retirement. Guys, nowadays a lot of people says that I want to retire early, I want to retire early. So the government has heard you, and they've come up with a very interesting concept which we are going to study next, which basically is called voluntary retirement. Now, what happens and what is this voluntary retirement? I'll call it VRS, voluntary retirement scheme. The government can't fire you in a lot of cases, or even some jobs can't fire you. So what they offer you is that why don't you take retirement on your own, voluntary? We'll give you some money, and but you have to leave the organization. You can't join back. Typically, it's given when people complete at least 10 years in an organization, and they should be at least 40 years of age in an organization. Now, we don't have to understand how it's given, etc. We have to understand the taxability. So in VRS, they give you a compensation. Example, let's say they give you 50 lakh rupees. So what do you do with that 50 lakh rupees? Obviously, it is taxable, but you get an exemption, which is least of the following. So VRS is also taxable, but with an exemption, which we will understand now. But the shortcut, guys, in VRS, when you're leaving the organization, will you get nostalgic? Will you look behind? Yes. And will you look in front? Yes. Both are yes. So let's see how is the exemption. What is it least of? First, as you can now guess, it will be the amount that is received. So amount received, let's say, is 50 lakh rupees. Second is a statutory limit, which used to be gratuity of 20 lakh. That was the limit in gratuity. Leave salary was a tiny limit of 3 lakh. Retrenchment compensation 5 lakh. And here again, it is 5 lakh rupees. This amount is fixed. Third is basically the average salary, the 10 months average salary. And when I say average salary, it is BDC. And this you're looking ahead. So basically, you have to see the number of months till retirement. So let's say you are now retiring, but the number of months, and yes, I said number of months till retirement. So you have to basically do 3 times the number of months into retirement. So I'll just show you the calculation, just a minute. So the VRS compensation, the first one is amount received, that is 50 lakh, then a statutory limit of 5 lakh. Then but it is basically BDC. Again, we've come back to BDC. Yes, in most cases, it is BDC only. So here we go. It is basically the BDC. Here we go. It is BDC. And you're looking ahead. So the number of years till retirement, how many number of years till retirement into 3 years till retirement. So this is what you have to see ahead. And fourth is again BDC. And basically, this is number of years that is completed. So here we go. So this is, sorry, so just one small correction here. It is BDC in both cases, the last drawn BDC. This into 3 months, 3 times into the number of years that is completed. So number of years that you've completed into 3, and this is BDC into number of months left till retirement. So I'm repeating. Excellent, guys. Very simple. This is voluntary retirement scheme. You've got some money, you add it and leads to the following: first amount received, second is 5 lakh rupees, third is BDC. You're looking back 3 times into the number of completed years, and looking ahead also into the number of years till retirement. Not 3. 3 does not come here. 3 is only here. And whichever is the least, you will get as an exemption, but it can be maximum 5 lakh rupees. So this is voluntary retirement scheme. This is one more retirement benefit done and dusted. Now, guys, we are moving towards the next one, which we've already discussed in class. I'll just recap this so that at one place you get all the retirement benefits. This is Provident Fund. Let's see, guys, what is Provident Fund, and I'll tell you quickly, recapping because we've already done this in class. There is a statutory Provident Fund. This can be opened by government employees, where the master's contribution, whatever the employer contributes, is exempt. On that master's contribution, whatever interest that you earn is also exempt, and the withdrawal is also exempt. So this is EEE, very good scheme of SPF. So please let your master contribute. Let's say your master contributes 1,50,000, it will be exempt. The interest on that will be exempt, and the withdrawal will also be exempt. Next, for private employees, there is something called Recognized Provident Fund, RPF. In that also, the master's contribution is exempt, but only up to 12% of your salary. So if your salary is 10 lakh rupees, 12% of that is 1,20,000, and if he contributes 1,50,000, then you will add 1,50,000, but the exemption will only be up to 12%. The interest is also exempt, but only up to 9.5%, and the withdrawal is also exempt, but only if it's done after 5 years. So if you withdraw within 5 years, then it will be taxable. After 5 years, it will be exempt. But remember, guys, within 5 years also, while it is taxable, it may be exempt if you are getting unemployed due to an illness or a disability. Then there is a URPF, Unrecognized Provident Fund. It's basically like a drawer which is maintained. No one knows about it. And hence, this one, again, is for private employees. Some employers make a URPF, Unrecognized Provident Fund. When the master puts in money there in the drawer, no one gets to use it. And hence, nothing, no tax, no exemption. Interest also is in the drawer, and hence no one gets to use it. And when you get the money out of it, it is taxable. Why no exemption? No exemption because the government has not got to use this money. So these are the 3 provident funds. This is P, that is post service. And last one, which is not important at all, I'm just going to talk about a superannuation fund. Just like you can have a bank account with HDFC and with HSBC account, same way you can also have a superannuation fund instead of a provident fund. What is this superannuation fund, guys? Superannuation fund. It is very similar to a PF account, a provident fund account. It is very similar. In this account also your master can contribute. You earn interest and you withdraw. So let's talk about the benefits from the tax perspective. So up to 1,50,000 rupees per annum. Up to 1,50,000 per annum. If your master contributes, it will be exempt. Anything above that will be taxable. So that is all on the superannuation fund. It's not really important. And quickly revising, guys, the short form here, surgeon loves government positions. S is basically SPF. So these 4 are also done. Let's do a quick revision with the sections. So guys, this is 1010. The exemption is 10 and this is number 10. Pension is 1010A. We don't have a shortcut for that. Leave salary is because you're always around. So it's 1010AA. Retrenchment is bad. People are firing you. So it's 1010B. Voluntary retirement, you see behind and you see ahead. So it is 1010C. So this is a short form of the shortcuts. Remember it. Watch this video again and again while we do a quick revision. First gratuity, then pension, leave salary, retrenchment compensation, voluntary retirement scheme, PF, and superannuation fund. Guys, in this 4 cases, surgeon loves government positions, SPF, leave salary, gratuity, and pension is exempt for government employees. But remember, anything received during employment while you're at work, while during employment is always and always taxable. So this is what it is, guys. Again, a caveat, this retirement fund or retirement benefits are not important from the exam perspective, and hence I've recorded this video. So every time you want to watch this or understand retirement benefits, just start this video, watch it till the end, and you'll be good to go. If you want to do one step further, take one sum from the book on gratuity, one on leave salary, and try and solve that as well. Remember BDC well. Remember BDOD is used only in one case of gratuity and one of retrenchment compensation. Remember these short forms and you'll be good to go. All the best. Reach out for any queries. Thank you so much. See you soon in the next video.